Picture this, it's a Tuesday, or maybe a Wednesday. Honestly, it doesn't matter, because for our lawyer, let's call her Amelia, every day feels like the Monday after a 3-day weekend where you spent the entire time doing your taxes. Amelia is sitting in her office, which has the distinct aroma of stale coffee and, quiet desperation. Before her, stacked so high it's basically creating its own weather system, is a mountain of paper. This isn't just any paper. This is loan documentation for a small business client trying to secure a multi-state commercial real estate loan. It's a labyrinth of applications, disclosures, promissory notes, and enough fine print to make even an eagle squint. Her job? To make sure every single word, every comma, every signature line complies with a dizzying array of federal and state laws. It is, to put it mildly, a Herculean task. She has to cross-reference the Truth in Lending Act, the Real Estate Settlement Procedures Act, the Equal Credit Opportunity Act, and honestly, a whole alphabet soup of other regulations. And that's just the federal stuff. The loan touches properties in California, Texas, and New York, each with its own special brand of regulatory nonsense. A single misplaced decimal point or an incorrectly calculated annual percentage rate could not only kill the deal but also land her client and potentially her firm in a world of legal and financial pain. This is not just paperwork, it's a minefield made of paper, and Amelia is standing right in the middle of it wearing tap shoes. The sheer volume is overwhelming. Each document is its own universe of potential errors. She has a checklist, of course. It's a 20-page document that she herself created, and it's already stained with coffee rings and highlighter marks that have bled together into an abstract, anxiety-inducing smear. The process is manual, tedious, and honestly, soul-crushingly repetitive. She has to read a line, check it against a regulation she's looked up for the 10th time that day, make a note, and then move to the next line, all while the clock on the wall ticks with the judgmental rhythm of a disappointed parent. So why is this so hard? Why does a simple loan require a forest's worth of paper and a lawyer's lifetime worth of sanity? Well, welcome to the magnificent, terrifying, and utterly bonkers world of United States loan regulation. It's not a single coherent set of rules. Oh no, that would be far too simple. Instead, it's a patchwork quilt of laws stitched together over decades, often in reaction to some catastrophic financial crisis. Think of it as a house where every time something breaks, instead of fixing it, they just nail a new, slightly different shaped room onto the side. Now, imagine trying to find the bathroom in that house in the dark. That's what navigating loan compliance feels like for a lawyer. The first major challenge is the sheer number of overlapping jurisdictions. You have the federal government, which throws down big, scary laws like the Truth in Lending Act, and the Real Estate Settlement Procedures Act, managed by agencies like the Consumer Financial Protection Bureau. But then, every single state, and sometimes even cities, decides to add their own special flavor of rules. A loan that is perfectly legal in Arizona might be catastrophically non-compliant in Massachusetts because of a tiny difference in usury laws or disclosure requirements. A lawyer has to be fluent in all of them, simultaneously. It's like being asked to speak English, Klingon, and Dothraki all in the same sentence, and if you mix them up, you get fined $1 million. Then there's the issue of constant change. These laws are not set in stone. They are living, breathing monsters that mutate. A new administration comes in, a new court ruling is handed down, or a regulator has a particularly spicy burrito for lunch and decides to issue new guidance, and suddenly, everything you thought you knew is wrong. The forms that were compliant yesterday are now obsolete. The interest rate calculation you memorized is now illegal. For a lawyer, staying current isn't a passive activity, it's an active, full-time battle. Finally, there is the mind-numbing complexity of the rules themselves. These regulations are not written in plain English. They are written in a dense, arcane language called legalese, which appears to be designed to be as confusing as possible. So our lawyer Amelia is drowning in a sea of regulatory chaos. The system is a mess, it's confusing, it's constantly changing, and it's actively hostile to simple human error. What's the solution? Do we give all lawyers a photographic memory and a direct IV drip of caffeine? No. The solution increasingly is technology. Specifically, it's a category of software known as compliance software, or more broadly, RegTech for regulatory technology. This isn't some magical artificial intelligence that does the whole job for you, not yet anyway. Think of it less as a self-driving car and more as the world's most advanced GPS, cruise control, and collision avoidance system, all rolled into one. At its core, compliance software is a sophisticated digital checklist on steroids. It takes that chaotic universe of federal and state regulations, all those acronyms like the Truth in Lending Act, the Real Estate Settlement Procedures Act, and the Equal Credit Opportunity Act, and digitizes them into a structured, searchable, and constantly updated database. Instead of Amelia having to manually flip through a dusty binder or search a clunky government website to find the exact wording of a specific rule, the software has it right there. More importantly, it translates the dense legalese into actionable rules and logic. It knows that for a mortgage in Florida, disclosure form X must be provided within 3 days, while for a similar mortgage in Oregon, it's form Y within 2 days. It codifies the chaos. But it's more than just a library of rules. The real power of this software is its ability to apply those rules to specific situations. A lawyer can input the key details of a loan, the loan amount, the property location, the borrower's information, the type of loan, and so on. The software then acts as a digital expert, running that specific loan scenario against its vast database of regulations. It's like having a hyper-focused, infinitely patient junior associate who has memorized every single law and never gets tired or asks for a coffee break. The software can instantly flag potential issues, highlight missing information, and ensure that all the necessary calculations are performed correctly according to the applicable laws. Let's get practical. How does this software actually make a difference? The answer lies in how the software directly attacks the main points of failure in the manual process: accuracy, speed, and error reduction. It takes the areas most prone to human mistakes and automates them with the cold, unfeeling precision of a machine. And in the world of loan compliance, cold, unfeeling precision is exactly what you want. It's a feature, not a bug. First, let's talk about accuracy, especially with numbers. Remember our old friend, the annual percentage rate? Manually calculating an annual percentage rate is a nightmare. You have to gather all the applicable fees, origination fees, points, certain closing costs, and plug them into a complicated formula. Compliance software automates this entirely. You input the raw data and the software, which is programmed with the precise formulas for every jurisdiction and loan type, spits out the correct annual percentage rate. The software instantly identifies which fees must be included in the calculation for a conventional 30-year mortgage in Ohio, and performs the calculation perfectly every single time. Next up is speed. The manual process is painstakingly slow. Amelia would have to find the correct disclosure form for a specific state, manually type or copy-paste all the borrower and loan information into it, and then check it against her list. This could take hours for a complex loan package. With compliance software, this process is condensed into minutes. Imagine a client needs a loan in Texas. The lawyer selects Texas residential mortgage from a drop-down menu, inputs the client's data once, and with a single click, the software generates all 50-plus pages of state and federal disclosures, perfectly formatted and filled out. Finally, and most critically, is error reduction. Humans make mistakes. We get tired, we get distracted, we transpose numbers. In loan law, these small mistakes can have huge consequences. The software acts as an infallible gatekeeper. It won't let you proceed if a required field is empty. It will flash a big red warning if a fee exceeds the legal limit in a particular state, something called high-cost or predatory lending thresholds. For instance, if a lawyer accidentally enters a broker fee that pushes the total points and fees over the 3% limit for a qualified mortgage, the software will immediately flag it, preventing a potentially catastrophic compliance violation before it ever happens. So, what are these magical software platforms actually made of? While different companies offer their own unique spin, most high-quality loan compliance software shares a core set of features designed to make a lawyer's life demonstrably less terrible. These aren't just fancy gadgets, they are purpose-built tools forged in the fires of regulatory audits and legal challenges. They're honestly like the digital equivalent of a Swiss Army knife for the compliance professional, with each tool designed to solve a very specific and very annoying problem. The absolute foundation of any good system is the regulatory rules engine. This is the brain of the operation. It's a massive, constantly updated database containing every relevant federal and state lending law, rule, and regulation. But it's not just a static library. The engine part is key. It uses complex logic to understand how these rules interact. It knows that Rule A from the federal government and Rule B from the state of Illinois apply to this loan, but Rule C from California does not. This engine is continuously updated by a team of legal experts and researchers who monitor legislative changes in real time, ensuring the advice the software gives is never out of date. This is the feature that saves lawyers from the endless task of personal research. Next, you have document generation and management. This feature automates the creation of the loan disclosure package. Instead of hunting for templates and manually filling them in, the lawyer uses the software to generate a complete, compliant set of documents with the click of a button. The system automatically selects the correct forms based on the loan type, state, and other factors. It then populates these forms with the borrower's data, ensuring consistency across dozens of pages. Furthermore, it manages version control so you can be certain you are always using the most current regulator-approved version of a form, not one you downloaded 3 years ago and saved to your desktop. It's one thing to describe the features of a car, but it's another thing to actually drive it on the road. The same is true for compliance software. Its true value becomes clear when you see how it's used in the day-to-day trenches of legal practice. These are not theoretical benefits. They are practical, real-world applications that solve concrete problems for lawyers and their clients every single day. From client intake to post-closing audits, the software becomes an integral part of the workflow, acting as a constant guide and safety net. A primary real-world use is in the initial client file review. When a lender or broker brings a new loan file to a lawyer, the first step is to check for immediate red flags. In the past, this was a manual, time-consuming review. Now, the lawyer or a paralegal can input the basic loan data into the compliance software. Within minutes, they get a preliminary report. For example, the software might immediately flag that the loan is in a state with a particularly tricky mortgage tax, or that the proposed fees are dangerously close to the state's usury ceiling. This allows the lawyer to spot potential deal breakers up front and advise the client accordingly, saving everyone weeks of wasted work.